Bismillah ar-Rahman ar-Rahim. Assalamu alaikum wa rahmatullah. In this video, I'm going to discuss the material and the topics covered in chapter 11, which revolves around the properties of stock options. Now, the properties and the relations that we will learn in this chapter does not only apply on stock options only, it could also apply on other options. However, starting from this chapter and moving forward, we will focus mainly on options written on stocks. Now, this chapter also serves as an introduction to option pricing, because it introduced to us the different factors that affect option prices. So to be able to understand how option pricing models work, or to develop an option pricing model, we need to determine what are the factors that affect option prices, which we will look in detail in this video. Before we start, let's agree on some notations that we will be using throughout this chapter and also moving forward. Now, if we are dealing with European call option prices, then we will refer to it by small c. If we are looking at an American call option price, then we will refer to it by capital C. If we are examining a European put option price, then we will refer to it by small p. And if we are dealing with an American put option price, then we will use the capital P as a notation. The stock price is referred to by S, and if it's today, it will be 0. If it's that time to maturity, then it will be kept at ST. K is the strike price or the exercise price. T is the life of the option, or the time until the option expires. D is the present value of dividends paid during the life of the option. And pay attention to the fact that D only includes dividends paid during the life of the option. Sigma is the volatility of the stock price, of the underlying stock price, and R is the risk-free rate for maturity T with continuous compounding. Let's begin by examining the factors that affect option prices. So there are 6 factors. What are these factors? The first one is the underlying stock price or spot price. The second one is the strike price or the exercise price. The third one is the time to expiration. The fourth one is the volatility or the standard deviation of the underlying stock price. And R is the risk-free rate with continuous compounding. And D is the present value of the dividends paid during the life of the option. Okay, now before we start discussing the different factors, we need to know how we are going to do this analysis. Well, first we are going to fix all other variables, and we will just change one variable. So all other variables will be the same, except one variable that we will be changing. And we will be looking at the effect of that variable on the intrinsic value to channel that effect on the option price. Now, in chapter 10, we discussed the 2 components of the option price. So we can disentangle the aggregate option price into 2 components. One is the intrinsic value and one is the time value. Now, other analysis could also divide the option price into more than 2 factors, but let's stick with the simplest approach, which is we consider only 2 values or 2 components of the option price. The intrinsic value for a call option is equal to the maximum between S minus K, and S will be the stock price at the time we are examining the intrinsic value, whether it's today or at the time to expiration, and K is the strike price of the option. For the put option, the intrinsic value is the maximum between K minus S or 0. Now, just to make sure that you understand how the max operator works. Now, if we ever are faced with the max operator, so let's say we have an equation that states X is equal to the maximum between 10 and 5. So the question is what's the value of X? Then X is going to equal to 10. Okay. Let's look at the effect of the underlying spot price on the option price. Now, first, let's look at call option prices, the relationship between call option prices and the underlying stock price. We observe from the chart that as we increase the underlying stock price, the call option price will increase. Now that's intuitive. Now if the strike price is fixed, the time to expiration is fixed, this means that the difference between the strike price and the spot price will increase. So, and if we look at the intrinsic value, we will find that as we increase the spot price, what will happen to the intrinsic value? It will increase. And if we increase the intrinsic value, what will happen to the option price? So also the call option price will increase. Similarly, if we decrease the underlying stock price, what will happen to the intrinsic value? It will decrease. Look, what's the effect? If S increased, K is fixed, this becomes larger, the intrinsic value becomes larger, which means the time value will not change because all other factors are the same. The option price or the call option price will increase. If we decrease S, what will happen to this part? It will also become smaller. If it becomes smaller, the intrinsic value will become smaller. And if the intrinsic value became smaller, then the call option price will decrease. So we can conclude that there is a positive relationship between S and the call option price. How about put options? Now, if we increase the underlying stock price, what will happen to the intrinsic value? Well, K is fixed, S increased, so it will become smaller, which means the intrinsic value will become smaller. And if the intrinsic value became smaller, what will happen to the option price? Then the put option will become smaller. Let's do the opposite. So we will decrease S. What will happen to the intrinsic value? Well, if we decrease S, then the difference will be larger, which means the intrinsic value will become larger. And if the intrinsic value becomes larger, what will happen to the option price, the put option price? It will become larger. So what do we conclude? We will conclude that there is a negative relationship between the underlying stock price and the put option price, as shown in the figure. Okay, let's look at the effect of the strike, changing the strike price. Now, we fix all other factors. They're all the same, they will not change, and we only change the strike price. So let's see what will happen. Now, if we increase the strike price, what will happen to the intrinsic value for a call option? So this becomes larger. This is fixed. It will not change. So the intrinsic value will become smaller, or it will decrease. If the intrinsic value decreases, what will happen to the call option price? It will also decrease. Let's do the opposite. Let's decrease the underlying the option strike price. We will find that if we decrease this, the difference will become larger. If the difference becomes larger, the intrinsic value will increase. And if the intrinsic value increased, what will happen to the call option price? It will increase. So what do we conclude? We conclude that there is a negative relationship between the strike price and the underlying and the call option price. Let's look what will happen if we change K on the put option price. So if we increase the strike price, what will happen to the strike? If we increase the strike price, what will happen to the intrinsic value? Well, if K becomes larger, the difference will become larger, which means the intrinsic value will increase. If the intrinsic value increases, what will happen to the put option price? It will increase as well. Okay, how about decreasing the strike price? How this will affect the intrinsic value? Well, if K becomes smaller, then the difference will become smaller, which means the intrinsic value will also decrease. And if the intrinsic value decreases, what will happen to the put option price? It's going to decrease. So what do we conclude? We conclude that there is a positive relationship between K and put option prices. Okay, next we examine the effect of the time to expiration and option prices. Let's assume that we have two options. They are similar in all other aspects except the time to expiration. So for example, one is going to expire after 1 month and the other is going to expire after 2 months. Now we learned in chapter 10 that as we become closer, or as the option becomes closer to the time to expiration, the time value for that option will decrease. If we reach the date on which the option will expire, the time value is equal to 0. Now for option A, which has an expiration after 2 months, and option B, which has an expiration after 1 month. Now after 1 month from now, is option A going to expire? Well, the answer is no. It still has an additional month. So should we expect the time value to be 0? It is less likely that the time value will be 0. But what we know for sure is that the time value for option B is going to be 0 after 1 month on time T1. This means that option A, the time value for option A should be at least equal 0, if not higher. If the both options are similar in every aspect except the time to expiration, and the time value for the first one is higher than 0 at time T1, shouldn't we expect that the option with the higher maturity will have a higher value? The answer is yes. Is that the only explanation why we should expect a higher or a positive relationship between option prices and time to expiration? Now, no. Now, what do we observe about the sensitivity? Another explanation is which option will have a higher chance of being expired in the money. Let's say we have an option that will expire tomorrow and an option that will expire after 1 year. The current status of the option is that it's out of the money. Which of the two options will have a higher chance to be expired in the money? The option that will expire tomorrow or the option that will expire after 1 year? Logically speaking, I should not expect there will be a large movement over a course of 1 year in the stock price. But it is reasonable to expect that there will be a large movement in the stock price over a course of 1 year. For this reason, because when we extend the time to expiration, we find that the probability of the option being exercised in the money will be higher. That is another explanation why as we increase the time to expiration, both option prices will increase. Now, do you notice something different between the relationship between the time to expiration, the call option, and the time to expiration, the put option? Which option has a higher sensitivity to the changes in the time to expiration? Well, if we look at the call option, we will find that the movement in the call option price is higher compared to the movement, a similar movement caused by the same change in the time to expiration on a put option. Why a call option is more sensitive to changes in the time to expiration compared to the put option? The answer for this question goes back to the definition of a call option and a definition of a put option. What is the definition of a call option? Well, the call option is the right to buy. Okay, how about the put option? A put option is the right to sell. So how this is related to the differences in the sensitivities to the time to expiration? Well, in the call option, remember, a right to buy means when you exercise, you will pay the strike price. When I tell you I'm going to extend the date on which you can exercise the right to buy, which means I'm going to delay, I'll give you the chance to delay paying cash or paying the strike price. Assuming that it will not affect you with other aspects. Do you prefer to pay early or you prefer to pay later? Well, it's the nature of people. If they are given the choice and there are no consequences on them, they would prefer always to pay later than paying sooner. That's why when we increase, there's a larger sensitivity between the call option price and the time to expiration, because it allows holders of the option to defer payment of the strike price. How about a put option? In the case of a put option, the put option is the right to sell. And the right to sell means when you exercise, you will receive the strike price. And when people are given the choice between receiving cash early or later, a rational person would like to receive cash early. That's the nature of people. So because extending the time to expiration means you will receive you will receive the strike price at a later time, in which people don't really prefer. That's why we see that the sensitivity is not as high to the time to expire, changing or the increase in the time to expiration compared to the call option price. Okay. Next, let's move to the fourth element, which is the volatility of the underlying stock price, which we refer to it by sigma. Now, volatility is considered an element of risk, and in general, investors, they don't like volatility, so it's undesirable by investors, except in the case of options. In the case of options, investors would like volatility. They desire volatility. Why that's the case? Well, it goes back to the definition of a volatility. What do we mean by a volatility? Now, volatility, in a simplest definition, is the dispersion of the variable, of the random variable that we are dealing with. And a synonym for volatility is also the standard deviation. So to understand how the volatility will affect the option price, let's look at the next examples. Before we examine these examples, let's do a quick review of some of the statistical concepts that you guys learned in the statistics course. Now, in any distribution, a distribution usually will explain what is the probability of a certain event that will occur. And any probability distribution has a mean and a variance and other parameters. What we are looking here at is a normal distribution, or the area under a normal curve. What does this tell us? Now, it tells us that there is a 68 or 67% chance that if we choose a variable randomly from a pool that has all possible values that this distribution describes, there will be 67 or 68% chance that the value will be one standard deviation above the mean or one standard deviation below the mean. And if we choose a value from a pool that includes all possible values under this distribution, there will be around 95% chance that the value will be within 2 standard deviations above the mean or 2 standard deviations below the mean. And 3 standard deviations above and below the mean will tell us what is the probability that a value will be, if we selected randomly from a pool that includes all possible values that are described by this distribution, the value will be within 3 standard deviations above or 3 standard deviations below, which constitute around 99%, 99.5%. Okay. How this is relevant to us? Let's examine 3 different stocks, stock A and B and C. Stock A has a distribution with a mean of 50 but 0 variance. So there is no variance. We know that after 1 month, the value of the stock will remain 50. And let's assume that there is an option written on this stock with a strike price of 60. And the option is a call. Will you be willing to buy this option? To answer this question, I have to ask myself, well, is there any probability that the option will expire after 1 month in the money? Well, by looking at the distribution, the volatility is 0, which means that it is impossible for this value, it is impossible for this option to expire in the money. If that's the case, why should people be willing to buy this option if it is impossible to expire in the money? Therefore, we should expect the price for an option written on the stock with a strike price of 60 is equal to 0. Okay, let's compare the distribution of stock A with the distribution of stock B. Stock B has a slightly higher volatility compared to stock A, and also it has a mean of 50, and it has an option written on the stock with a strike price of 60. Now my question to you is, will you be willing to buy the option written on stock B, a call option? The answer to this question depends on whether this option has a chance to expire in the money. Now, even though the probability is not high, but it's still attractive to the investors. So yes, compared to stock A, stock B will find someone who will be willing to buy the option written on stock B. Okay, how about stock C? Again, the option is written on stock C with strike price of 60, but the volatility or the standard deviation of this distribution is quite high compared to stock B and stock A. So what does this tell us? Well, here it means that there is a higher chance or a higher probability that the option will expire in the money. In this case, which option we expect will have a higher price? The option written on stock C or the option written on stock B? Well, logically speaking, the option written on stock C will have a higher chance to be exercised in the money. So for this reason, people are willing to pay a higher price for it compared to the option written on stock B. Let's take here a numerical example that will also prove that volatility will have an effect, a positive effect, on option prices. Let's assume we have option on stock A and option written on stock B. Now both options have the same exercise price, which is 30, so K is equal to 30, and the option the underlying stock written the stock underlying option A has a high volatility, while the stock that is the underlying asset for option B has a low volatility. Now let's assume that we know that the possible values for the stock after 1 month from now are 10, 20, 30, 40, and 50. And also the volatility on the stock underlying option B ranges from 20 to 25, 30, 35, 40. So we can see that the underlying for A has a higher volatility compared to the underlying for B. Now what we are trying to find? We are trying to find the expected value for the option payoff. What would be the expected option payoff? Now we learned in statistics to find the expected payoff or the expected value, we multiply the price of the event that will take place times the probability of occurrence for that event. Now here we have only 5 possible prices, and each price is equally weighted in terms of probability of occurrence. Then we can safely assume that K is equal, we can safely assume that the probability for each price is going to be 20%. Now, I want to find the expected value or the expected payoff of option A, which is 0.2. So from where did you get 0.2? 20%. It's the possibility of each price going to take place, times 10 plus 0.2 times 20, and this will give us 6. How about the expected payoff, option payoff for option B? Again, we multiply the probability (0.2). Each price has a probability of 0.2, so the total probabilities is going to equal to 1 or 100% times 5. So we'll multiply what is the probability that the price 35 will take place, and then we'll multiply it by the price we observe for the or the payoff of the option, plus 0.2 times 10, and we will get a value of 3. So this proves that for the option with the high volatility, it will have a higher expected payoff. And if it has a higher expected payoff, shouldn't we expect also it will have a higher price? The answer is yes. Next, we move to the effect of interest rates on option prices. Now here the channel is a little bit different to understand the effect of interest rates and option prices. It's basically based on the lower bound for each option. Now we will see after a few slides that the lower bound for a call option is equal to the maximum between S minus K discounted to the power of RT. That's for a call. How about a put? Well, for the put, the lower bound is the maximum between K times e to the power of RT minus S or 0. We are missing here or 0. So now let's look at the effect of the interest rate on the lower bound for each option. If we increase the interest rate, what will happen to K, the present value of K? It will decrease. So if it decreases, what will happen to the difference between S and the present value of the strike price? It will increase. How about the case of a put option? Well, if we increase the interest rate, what will happen to the present value of K? It will become smaller. And if it became smaller, what will happen to the underlying stock price? So the difference between the strike price and the underlying stock price, it will become smaller. And if it becomes smaller, the lower bound will become smaller, which means the price of the option also put option will decrease. Is this the only explanation? Well, also there is another explanation. It also relates to what's the definition of each option. A call option is the right to buy. And logically speaking, when you enter into a call option, you will have the strike price with you, or you will keep it in an account and earn interest on it until you need it. So you will take part to pay for the premium, and you will keep the rest in an account that pays you interest. If interest rate increased, what will happen to the interest you will receive? It will increase as well. So this feature makes call options higher and much more desirable than put options. How about put options? Now, a put option is the right to sell. So if you do not exercise, you are not receiving the strike price. And if you did not receive the strike price, you don't have the chance to invest it in the risk-free asset. So you are deprived of the chance of being able to reinvest it in an account that pays a higher interest. For this reason, call options have a positive relationship with the risk-free rate, and put options have a negative relationship with the underlying, with the risk-free rate. Okay, this table will summarize the effect of each of the 6 factors on both European and American options. So for the relationship between the spot price and the call options price, whether they are European or American, is positive, and it is negative when we are dealing or comparing the underlying spot price and the put option price. Okay, how about the effect of the option strike price? Well, it's the opposite of the effect of the stock price. The strike price has a negative relationship with calls and a positive relationship with puts. How about time to expiration? Now, for American options, it is obvious that when we increase the time to expiration, the option price will increase as well. But for European options, it's unclear because it depends whether or not there will be dividend payment, which we did not discuss yet. Let's discuss the dividend payments, then we will go back to time t. Now, let's move with the next 2 factors, then we will discuss the effect of the dividends. So the volatility or the underlying stock price standard deviation has a positive relationship whether we are dealing with calls or puts on American or European. As we saw recently also in few minutes, that there is a positive relationship between the European or American call option prices and the underlying again, there is a positive relationship between the risk-free rate and call options, whether they are European or American, and there is a negative relationship between the risk-free rate and put options, whether they are American or European. To understand the effect of the dividends, we need to see how the dividends will affect the underlying stock price. So the channel to understand the effect of the dividends is through the effect of the dividend on the underlying stock price. Now we know when a company declares a dividend, there are 3 important dates. So there is the announcement date, there is the ex-dividend date, and there is the date on which the distribution will take place. So announcement and ex-dividend and distribution. Now what matters for options is the ex-dividend date, because investors who own the stock before the ex-dividend date, who are recorded in the shareholders record before the ex-dividend date, will receive payments. Anyone who buys a stock on the ex-dividend date will not receive a dividend. Because of this, we will notice that there will be a drop in the stock price as the result of the dividend entitlement. Now, because a drop in the stock price is a bad news for the call option and good news for the put options, we will observe that there is a negative relationship between dividend paid and the call option, or call option, whether it's the American or European. And because a drop in the underlying stock price is a good news for a put option, that's why we observe that there is a positive relationship between dividends and put options, whether they are American or European. Okay. Next, we will discuss some conditions that govern or regulate option prices, which means if these conditions are not met, then there will be an arbitrage opportunity. So the first condition that we will be discussing is the relationship between an American option and a European option, whether it's a call or put. So we know from the definition of a European put or American or put option, they are only possible to be exercised on the expiration date. For an American option, they are also possible to exercise on the expiration date, plus we can exercise the call and put anytime before the expiration date. So we can see that an American option is or includes the European option plus an additional option. If that is the case, shouldn't we expect the call option or the put option prices for an American option should be greater than the European options? Well, the minimum that both options, at least the minimum value for the American call or American put, is that should equal to the European, but it also could be greater. But it is impossible for the American to be lower than the European, and that's the case for calls or puts. Okay, that's the first condition. The second condition is based on what is the minimum value, minimum possible value the option price can take. Now, if you want to look at it from a mathematical point of view, what is the minimum value that the time value can take? Well, we learned from chapter 10 that's the lowest value the time value can take is 0. How about the intrinsic value? What is the minimum value? Well, beginning with calls or puts, the minimum for the intrinsic value is also 0. If the minimum possible values for the time value intrinsic values are 0, then what can we conclude will be the minimum value for option prices, whether calls or puts? It's also 0. So the second condition is that the price of the put option should be greater than or equal to 0. Price, that's for American or for European. And the price for an American call should be greater than or equal to 0. And that's and the same applies for European. Okay, so here we learned 2 conditions. Next, suppose that we observe in the market for a call option that has a price of $3, the underlying spot price is 20, the time to expiration is 1 year, the strike price is 18, and the risk-free rate is 10%, and the stock does not pay any dividends. Is there an arbitrage opportunity? Now, let's assume that someone told us that yes, there is an arbitrage opportunity because the price of the option should not be lower than 3.71. So let's assume that the call option price should not be lower than 3.71. However, we observed that the price is 3, which is lower than 3.71. So we can conclude that there is an arbitrage opportunity. Okay, what should we do whenever we are dealing with an arbitrage opportunity, when we are dealing with derivatives? Well, we apply or we follow the golden rule, which is buy low, sell high. So in our case, what is the low? It's the option. So to lock in the arbitrage, I will short the underlying stock and I will receive 20. I will use part of the 20 to take a long position in the call option, which means I will pay $3. And the remaining cash flow will be 17, which I will use to invest in the risk-free asset after 1 year at 10%. Now, since we are dealing with options, what are the possible scenarios that can take place after 1 year? Well, since I'm dealing with an option, either the option will be exercised or it will not be exercised. Either the option will be in the money or will be out of the money. So let's see. After 1 year, if the price of the underlying stock is higher than 18, which means the call option is in the money. So what? Now, okay, let's see first what should we do. Well, the risk-free investment will grow to 18.79. And since the call option is in the money, and how did we conclude it's in the money? Well, the price in the market is higher than 18. So it doesn't make sense to exercise and buy at a lower price compared to the market price? Yes. So I will exercise the call and I will buy the stock, which means I will pay 18. Now I will use the stock I got from exercising the option to close the short position in the stock. This way I have concluded all the transactions necessary to complete the arbitrage related transactions. So I calculate my arbitrage profit. It will be 18.79 minus 18, and net riskless profit will be 0.79. Okay, that's the case when the option expire in the money. What if the option expired out of the money? Let's say ST is less than 18, so let's take for an example a price equal to 17. My risk-free investment will become 18.79, so that will not change, but the call option will be out of the money, which means it will expire worthless, so it doesn't make any sense to exercise the call option. Type. I still have an option, I still have a short position in the stock that I need to cover. How can I cover it? Well, I will buy the stock directly from the spot market. So I'll pay 17 and I will receive the stock. I will use the stock to cover the short position that I have in the stock, and here I have completed all the transactions related to the arbitrage. What will be my arbitrage profit? I received 18.79, I paid 17, so net profit will be 1.79. Now, it turns out that for options, there are a lower bound and an upper bound. Now, an upper bound and a lower bound. Why we can't say that if the price of the option is different from a certain price, then there is an arbitrage? Well, There are many factors. Now, options are not like forwards or futures. We learned in chapter 5 that in the case of forwards or futures on investment asset, if the price is above or below the no arbitrage price or the synthetic price, forward price, then there is an arbitrage. We cannot say the same thing for call options or even put options because options are one of the mostly difficult or one of the most difficult tasks in finance that we ever deal with is to properly price options all the time, or to reach a model that works all the time to price options. So, although there has been a significant development that occurred in the area of trying to develop an option pricing model that will work all the time, still all the attempts did not succeed to work under all scenarios, under all conditions, under all possible situations. However, we know that the price of the option is governed by also the bounds, the upper bound and the lower bound. If the price is below the lower bound or above the upper bound, then there is an arbitrage opportunity. If the price is in between the lower and the upper bound, then we cannot say that there is an arbitrage opportunity. So what's the lower bound? Well, if we just calculate the lower bound, which is basically is 0 minus the present value of the strike price, the difference between these two numbers and the maximum between the difference and 0. So let's calculate the lower bound, which is 20 minus 18 times e to the power of minus 0.1 times 1, and this will lead us to 3.71, which means C should be greater than or equal to the maximum of 3.71 or 0, which lead us to conclude that C should be greater than or equal to 3.71. So that's the lower bound. Okay, how about the upper bound? What do you think will be the upper bound for a call option? Now, let's take this example. Let's assume we observe in the market that S is equal to 50. K is equal to 40. And the call option price is equal to 60. Do you think there is something wrong with these numbers? Do they look normal? Just take a second to reflect on these prices. What do these prices imply? It implies that the right to buy an underlying asset that has a price of 50 today is equal to 60. Does this make sense? Will you be willing to pay for the right to buy something more than what it costs you to buy that underlying asset? So here, if I want to buy the stock, it will cost me 50. To buy the right to buy the stock, it will cost me 60, which does not make any sense. So the upper bound in this case will be S0. Because I will not pay for the right to buy the underlying stock more than what it cost to buy the stock today. What if I observe this? So let's say we went to the market and we observe these prices. What should we do? Well, you have to immediately apply the golden rule, which is buy low, sell high. In our case here, I will short the call option. I will receive a premium of 60. I will use 50 to buy the underlying stock, and we will wait. So I will invest 10 in the risk-free rate and wait for 1 year. If the counterparty, the person who took a long position, decided to exercise, well, I will deliver the stock to him and he will pay me 40. So I'll get 40 plus whatever the $10 will increase after investing in the risk-free asset. If he did not exercise, then I will receive my cash from the risk-free investment and I will sell the stock for whatever is the price in the market, and still I have made a profit. So what is the upper bound again in our scenario here in the example, in the previous example? It's 20. So 20 upper bound, 3.71 lower bound. Okay, that's for the case of a call option, and we are specifically dealing with a European call option. And it's important to keep in mind that we are dealing with a call option that does not pay any dividends. How about the case of a European put option? So here we observe that the price of a European put option is 1. T is equal to 6 months. The strike price is equal to 40. The underlying stock price is 37, and the risk-free rate is 5%, and the underlying stock does not pay any dividends. Is there an arbitrage opportunity? Let's assume that someone told us the price of the put option should not be lower than 2.01. However, we observed in the example that the price is equal to $1. So what should we do today? Well, applying the golden rule, we should buy low. And buying low means I have to take a long position in the put option. Now, in the put option, it's a special case, because if I took a position in the put option, I should take the same position in the stock price, so in the underlying stock. So if I take a long in the put, I should also take a long in the stock. And later we will see why that's the case. Okay, so to start today, I will borrow $38 for 6 months. Why 38? Because I want to buy one put option which cost $1, and I want to buy one stock which cost 37. After 6 months, what are the possible scenarios? Also, since we are dealing with options, either the option will be in the money or out of the money. Let's see the case when ST is less than 40. The loan will grow to 38.96. So I have to return back 38.96. So, but how can I do this? Well, first, let's see. The put option is in the money or out. Well, since ST is lower than 40, the strike price, then the put option is in the money. It makes sense to exercise the put option, which means I will deliver the stock that I have and I will receive 40. Now I will use the 40 to repay the loan. And once I repay the loan, I have concluded all the transactions that are related to the arbitrage opportunity, and my arbitrage profit will be 1.04. Let's look at the second scenario in which ST is greater than 40. So let's take, for example, ST is equal to 42. Again, the loan will grow to 38.96. That will not change. The put option will be out of the money. Since the spot price is higher than the strike price, it doesn't make any sense to exercise the put option. So it will expire worthless. However, I still have a loan that I have to payback. So how can I do this? Well, I will take the stock and sell it directly in the market, which means I will receive 42. I will use part of the 42 to repay the loan, and by doing this I complete all the transactions related to the arbitrage opportunity. So my arbitrage profit will be, I received 42 and I paid 38.96, so the riskless profit will be 3.04. So it turns out that, as in the call option case, also a put option has an upper bound and a lower bound. What is the upper bound and what is the lower bound? So the lower bound first is basically we calculate the values. So K, we know K is equal to 40 times e to the power of minus 0.05 times 0.5 minus 37, I believe, yes, 37, which equals to 2.01. So the lower bound for the put option is the maximum between 2.01 and 0, which lead us to conclude that the lower bound for the put option is 2.01. So that's the lower bound. If the price dropped below 2.01, then there is an arbitrage opportunity. Okay, how about the upper bound? What do you think will be the upper bound for a put option? Well, again, let's take a quick example. Let's say S is equal to 30, K is equal to 50, and the price of the European put option is equal to 60. Does these numbers look right? I'll give you a second to reflect. What do they mean? It means the right to sell something and receive 50 cost you 60. Now, a put option is the right to sell, which means when you sell, you receive the strike price. So, will you be willing to pay for receiving $60? Well, logically speaking, if you're a rational person, you will not be willing to do this, because you will never profit out of exercising the put option. So the maximum you will be willing to pay for a put option is the strike price. That will be now the upper bound. Okay, which is in our case 40. If the price in the previous example is above 40 or below 2.01, then there is an arbitrage. In any price in between, we cannot say that there is an arbitrage. At least learning that these are the lower and upper bound conditions. So let's do a quick recap. What are the conditions we covered that governs or regulate how the price of options are determined? First, American call option prices could not be lower than the European. They could be equal, but usually you expect them to be higher or greater. Second, the price of options, whether European or American, could not be negative. So the lowest they can reach is 0, or they can be higher than 0. The third condition, the price of the options should not be lower than the lower bound or higher than the upper bound. Okay. Now next we turn to a relationship between put and call options. So their put and call options are not determined also arbitrarily. There is a relationship between put and calls, and it's governed by the put-call parity. We will now examine the put-call parity on options that are written on the same underlying asset. They have the same strike price, same time to expiration. Just only one is a call, one is a put. Now consider the following two portfolios. We have a portfolio A, which consists of a European call on the stock and a zero coupon bond that pays the strike price K at time T. So it pays a value that is similar to the strike price, which is K at time T. And the second portfolio is includes a European put option on the stock plus the stock itself. Let's examine the behavior of these two portfolios under two different range of prices. So since we are dealing with options, either the options will be either the underlying stock price will be greater than K or will be lower than K. Okay, if the first case the underlying spot price is higher than K at the maturity, then what will be the payoff from the call option? Well, at maturity, the payoff will be if ST is greater than K, then the call option will be in the money, and the payoff will be ST minus K. What will be the value of the zero coupon bond? Well, it will grow, so it will pay a value of K. So that's the face value of the bond. Combined, what will be the value of portfolio A? Well, ST minus K plus K means that the value of portfolio A is going to be ST. How about portfolio C? If ST is greater than K, then the put option will be out of the money, which means the payoff will be 0. And the price of the stock is ST. So the value of portfolio C combined is going to be also ST. Okay, what about the case when ST is lower than K? The call option will be out of the money, it will expire worthless, and the payoff will be 0. The zero coupon bond will pay K, so combined for portfolio A, the value will be K. How about portfolio C? The put option, since ST is less than K, the put option will be in the money. So the payoff will be K minus ST. And the price of the stock is whatever we observe at time T, which is ST. So combined for portfolio C, the value will be K minus ST plus ST. So we will have a value for portfolio C that is equal to K. What does this tell us? It tells us at the time when the options expire, whether ST is greater than K or ST lower than K, always portfolio A will have the same value as portfolio C. ST greater than K, value of A will be ST, and the value of portfolio C is ST. If the prices in the spot market of the underlying stock is lower than K, the value for portfolio A is K, the value of portfolio C is also K. Now, if both portfolios have the same value, no matter what is the underlying stock price, at time T, shouldn't we expect that they have the same price or the same value today? Well, the answer is yes. Okay, then what will be the value of portfolio A today? Well, remember, portfolio A consists of the call option price and a coupon bond that pays K at maturity. So what will be the value of the coupon pays K at time T? It's the present value of K today. So the present value, or the K discounted and the price of the call option is the value for portfolio A today. Okay. How about portfolio C? The portfolio C includes or consists of the put option and the underlying stock price. So their value today is the price of the put option and the price of the stock today. So they combined form the value of portfolio B or C. Let's be consistent. So C, as mentioned in the previous example. So the value of portfolio A and the value of portfolio C today should equal. If they do not equal, then we conclude that there is an arbitrage opportunity. So this is the fourth condition that we will rely on to understand or to make sure that there is no arbitrage opportunity when we are dealing with options. Let's take an example. So suppose that we observe in the market that the price of the call option is 3, the underlying stock price is 31, strike price 30, the option expire after 3 months, the risk-free rate is 10%, and the underlying asset does not pay dividends. Are there arbitrage possibilities when case number 1, the price of the put is equal to 2.25? Let's see. So to deal with this example, we need to examine the put-call parity condition. We will have to see whether the put-call parity holds or no. So the put-call parity states that the price of the call plus the present value of the strike price should equal to the price of the put plus the price of the underlying stock. Let's call the left-hand side number 1 of the equation and the right-hand side, let's call it number 2, and let's examine each one separately. So number 1, the price of the call plus the present value of the strike price, we will get 32.26. For number 2, the price of the put plus the price of the underlying stock price, so we get 33.25, and we can conclude that number 1 does not equal to number 2, which means that there is an arbitrage opportunity. What should we do when we are faced with an arbitrage opportunity? Well, we apply the golden rule. And we know that the golden rule states that we should buy low and sell high. Okay. In our scenario here, in the example we are dealing with, portfolio 2 is overpriced relative to portfolio 1. So which one we should sell and which one we should buy? Obviously, we sell portfolio 2 and we use the proceeds to buy portfolio 1. How can we do this? Let's see. So today we will short 1 stock and we will short 1 put. So in total we will receive 33.25. I will use part of the 33.25 to buy 1 call option, which costs $3. What is left is 30.25. I will invest the 30.25 in the risk-free asset for 3 months. By this, I locked in the arbitrage and I have to wait for 3 months. So I took a position in the underlying stock and the put. I took a position in the call. I invested in, or I took also a position in the money market. So here all the elements necessary to lock in the arbitrage are already taken. So after 3 months, there are 2 possible scenarios as we saw before. Either ST is greater than the strike price or ST is lower than the strike price. Now let's take the first example when ST is greater than 30? Well, the risk-free investment will grow to 31.02. The call option will be in the money because ST is greater than 30, so it makes sense to exercise the call price, so the call option. So we will exercise the call option, we will pay 30, and we will receive the stock. How about the put option? Well, since ST is greater than 30, then the put option will be out of the money, which means it will expire worthless. Now, I will use the stock that I bought by exercising the call option to cover the short position in the stock. Remember, when he initiated when we took the steps to lock in the arbitrage, we shorted the stock. So we need to cover our short position. Once we cover the short position, we have completed all necessary steps to realize the arbitrage profit, which will be 1.02. So we received 31.202 and we paid 30. That will be the arbitrage profit. The second case, when ST is less than the strike price, which is 30, again the risk-free investment will grow to 31.02. That will not change. However, the call option will be out of the money, and when it is out of the money, it will expire worthless. The put option will be in the money, and remember, what position did we take in the put? We take a short position. So when the option is going to be exercised, it will be exercised by the long trader or the long investor, which means he will sell me the underlying stock and receive 30, which means I will pay 30 and receive the stock. Okay, so I pay 30 and receive the stock. I will use the stock to cover the short position. By this, I conclude all the steps necessary to realize the arbitrage profit. My arbitrage profit will be 31.02 minus 30. I received 31.02. I paid 30, so net I will realize 1.02 as a profit. So we saw the arbitrage possibility when the price of the put option is 2.25. What about if the put option price that we observe in the market is equal to $1? Let's see. So we re-examine the put call parity condition. Portfolio 1 will not change, the value will be 32.26. Portfolio number 2, $1 for the put option and 31 for the stock, so total is 32, which means portfolio 1 does not equal to portfolio 2, and this implies that there is an arbitrage opportunity. Whenever we face an arbitrage opportunity, again we apply the golden rule, which is buy low and sell high. In our case here, which portfolio is low or has a low price and which portfolio has a high price? Number 2 has a low price or is underpriced relative to 1, and number 1 is overpriced relative to 2. So what should we do today? So today we will short one call option, which means we will receive $3, and we need to borrow 29 in order to have 32. Why do we need 32? Because I want to buy one put option and I want to buy one stock. So a put option and a stock, they cost me together 32, and I need to have enough cash to be able to buy them. When I borrow 29 and I receive $3, I have enough cash to finance the long position in the put in the stock, and we locked in the arbitrage. What could happen after 3 months? Let's see. So let's look at the scenario when ST is greater than 30. Well, first the loan will grow to 29.73. The call option will be in the money because ST is greater than the strike price. And remember that I took a short position in the call option. So I have the obligation to execute the transaction. The holder of the call will exercise because it is in his best interest to exercise. So I will deliver the stock to him and I will receive 30. How about the put option? Since ST is greater than 30, the put option will expire worthless. I will use this 30 to repay the loan, and I'm ready to calculate my arbitrage profit. I received 30, I paid 29.73, so net profit will be 0.27. Let's examine the second scenario in which ST is going to be less than the strike price, or less than 30. Again, the loan will not change, it will grow to 29.73. The call in this case will be out of the money, which means it will expire worthless. The put option is in the money, and since I took a long position in the put, I will exercise the put. What does it mean? It means I will deliver the stock and receive the strike price of 30. I will use the 30 to repay the loan, and then I'm ready to calculate my arbitrage profit, which is going to be also 0.27. Now, we turn to the issue of discussing whether or not we should exercise early an American option. Now, let's focus first on an American call. And an American call on a non-dividend paying stock. Should we exercise it early or no? Consider this example. You have an American call option with a strike price of 60. The time to expiration is 3 months, and the current stock price is 30. And let's say that you are planning not to speculate in the stock, which means you want to buy it and sell it early. No, you want to keep it in your portfolio. Should you exercise early or no? Think about it for a moment. Well, the option is in the money, but does it mean is it better for me to exercise or it's better for me to wait? I want you to look at this possible scenario for the movement in the stock price. Now, time t is when the option expires after 3 months. 60 is the strike price in which you can exercise if the price of the stock is higher, and you will not exercise if the price is lower. Now, if I exercise today, okay, which means I'm going to pay 60 for the underlying stock, and my intention is to keep the stock in my portfolio for the medium term. So the time will pass, and at the expiration we will discover that the price of the stock is lower than 60. So what did I gain? I gained absolutely nothing. Instead, I lost the chance of buying the stock at a lower price. So this illustrates that for an American option, it is not always optimal to exercise early. In fact, it is optimal to not exercise early, except if there is a dividend payment. Now, in this scenario here, yes, maybe if I exercise today, we can find that the price was fluctuating, and until after time t, the difference was higher. So if I exercise early, or I didn't exercise early, I will pay the same amount. But this particular scenario, it shows that it's better if you have an American call option to exercise or to wait until on the expiration date, and then you decide whether to exercise or no. This is particularly true because we are not sacrificing any income, and we are delaying paying the strike price. So we could keep the strike price in an account that pays interest. In fact, holding the call provides us insurance against the price falling below the strike price, as in the chart, as in the previous chart we saw. Okay, if that's the case for an American call option, which is it is not optimal to exercise early, then what would be the bounds for a European call option? Well, it will be similar to a European. So for the upper bound and the lower bound for an American call option will be similar to a European call option, because both you will not exercise early. The upper bound will be as 0. The lower bound is the maximum between the difference between the current stock price minus the present value of the strike price, or 0. How about the case for a put option? Should we exercise early? The case for a put option is a bit different. Why? Now, let's examine the following. Say, we observe in the market the price of the stock is 60, the strike price is 100, and the time to expiration is 3 months. Should we exercise early? Now, to answer this question, let's answer the following question. When will, at what price we will receive the maximum profit in a put option, or the maximum payoff? So let's take an extreme example. There were rumors that the company on which the put option is written is going to go bankrupt. So the price of the stock dropped to close to 0, only cents. Now, should you wait before you exercise, or you should exercise immediately? To answer this question, is there a potential to increase the payoff? Well, the price is close to 0. It cannot go any lower than that. In this case, it is optimal to exercise early. Why? Because if you waited a little bit, maybe the price of the stock will go up. If the price of the stock went up, what will happen to the payoff you will receive? It will decrease. Okay? So, to summarize, for a put option, if the price of the stock went down enough to make us believe that it will not go any further below that price, it is optimal to exercise early, because we want to lock in the highest possible payoff out of the put option. For this reason, the bounds for a European put option are different from the bounds of an American put option. For a put option, American put option, the maximum, the upper bound should not exceed K, and the lower bound should not be lower than K minus S0. However, for a European put option, the upper bound is the present value of K, and the lower bound is the difference between the present value of K and S0, or the maximum between the difference of these two values, or 0. Okay. In all our previous discussions, we assumed that the underlying stock does not pay dividends. What if the underlying stock does pay dividends? Well, there's a slight adjustment that we need to do on the lower bound for both the call and the put. So the lower bound for the call, we will deduct from it the present value of the dividends that are going to be paid during the life of the option. For the lower bound of the put option, we are going to add the present value of the dividends paid during the life of the put option. Now, this will lead us to extensions of the put-call parity. In the case of an American options, in which there are no dividend payments, we cannot reach an exact equation like what we saw in the case of European options. For American options, the difference between the call and the put should be lower than this value and higher than this value. If the difference is greater than this value or lower than this value, then there is an arbitrage. But we cannot say that the price relative to this price, if it is not equal, then there is an arbitrage. No, we look only at the difference between the call and the put, and we see whether this difference is within the range where there will be no arbitrage opportunity. If we want to introduce dividends on the underlying stock during the life of the options, we will adjust the call-put parity by adding the present value of the dividends to portfolio 1 or portfolio A. So the left-hand side will be the call price plus the present value of the dividends plus the present value of the strike price is equal to the put option price plus the underlying stock price. If we want to introduce dividends for the put-call parity for American options, well, we deduct the dividend from the left-hand side of the inequality, and if the range or if the differences between the call and the put is greater than this part or lower than this part, then there is an arbitrage opportunity. So that's it for our discussion of chapter 11. I hope you find it useful. Thank you for listening. Assalamu alaikum.